Welcome, trader. This is Steven with TMT. No pain, all gain. Now let's trade some knowledge. Trading comes with many challenges. One challenge, however, that almost all traders will face is behavioral finance. That is, enduring the psychological effects of investing in financial markets. As if becoming a financial expert and learning to trade wasn't difficult enough, being human introduces yet another obstacle in the game of capital risk. Almost every experienced trader can attest that overcoming and resisting the psychological effects and urges that come from trading are some of the biggest hurdles in becoming a profitable trader. Similar to gambling, trading can elicit strong urges and irrational decisions, usually counterintuitive to what the trader is trying to achieve. This usually results in buying high and selling low, as well as mismanaging margin and a higher volume of transactions. It's not to say that you shouldn't feel these emotions. You're human after all. What's important is that you're aware of these impulses and have a system in place to save you from yourself. Trading is a game of process, discipline, and patience. All three get tested during times of volatility in the market. How one prepares for and responds to volatility generally governs the success of traders, no matter the time frame you're working in. Understanding the reasons behind the volatility and the impact it may or may not have on a particular company for the near or long term is part of your due diligence as a modern trader. Volatility is typically at its highest when there's an overwhelming amount of fear or euphoria surrounding the market or a specific company. Euphoria in the stock market is arguably a result of fear as well, that is, the fear of missing out. As prices climb, people may look to buy more and drive prices even higher. This can create a bubbling effect, where a company's stock price detaches from the intrinsic value and earnings power of the company itself. For example, consider company XYZ. Over the past year, they earned a total of $1 per share. If we apply a fair multiple of 15 times earnings per share, a fair price for the company's stock would be $15 per share. The $1 earnings per share would be the intrinsic value, and $15 per share would be the fair market price for buying a company generating $1 earnings per share. The two result in a price-to-earnings ratio of 15. When we check the stock market, however, we find that the stock is listed at $75 per share. For this to be a fair price, the company would need to be earning $5 per share. This detachment creates the bubble and indirectly sets high expectations for the company to generate additional earnings at an accelerated rate that likely isn't feasible. Instead, what happens is that these frothy valuations and expectations are abandoned and reduced to something more realistic. Knowing this, you avoid buying the stock at this price. What follows for the stock is something called the rollover effect. General selling brings buying momentum to a halt, and the stock price rolls over and starts heading downwards. Without intrinsic value as support, an avalanche of panic selling ensues. You watch happily, knowing that you avoided catastrophe. However, you keep this stock on watch because the underlying company is in a strong financial position, has exhibited a steady increase in earnings, and has great prospects for growth. The panic selling continues over the next couple months and forces the stock price all the way back down to $10 a share. This is well below the fair value, and it triggers you to put it up for investment consideration. You decide to wait until the company releases its current quarter's earnings report in order to further validate the company's earnings momentum and search for any red flags that may justify this seemingly low valuation. The earnings report proves to be heavily positive, with management even increasing the dividend. With all boxes checked, you enter a buy order and become a shareholder of XYZ. Sure enough, the market recognizes the stock is undervalued and the share price quickly retracts to its fair value. As you can see, understanding behavioral finance can help you not only avoid disastrous situations, it can also help you recognize market inefficiencies and identify opportunities. Trading is an emotionally taxing endeavor. Developing the psychological skills necessary to endure the market's ruthless tests is a major step on your path to becoming the modern trader.